Transactions. Now, these are honestly the meat in the accounting sandwich, which I know sounds completely mad, but let me explain. Without transactions, your profit and loss account, balance sheet and trial balance would be totally empty. We don't want that now, do we? Without a filling, a sandwich is just bread. Without transactions, a set of accounts is simply blank lines on a page, nothing else. So what is an accounting transaction? An accounting transaction is a record of an action made by a business. So for example, transaction might be paying bills, buying stock, recording a sale, or receiving money due from a customer. Now, transactions are categorised in the accounts depending on what the transaction is. For example, it could be a fixed asset, liability, or equity. I suppose it sounds a bit like I'm talking French at the moment, but don't worry, let me explain with a few examples in the next slides. So let's go have a look, shall we? Each part of a transaction is attached to a category in the accounts. So, each part of a transaction corresponds to one of these categories as revenue, direct costs, overhead costs, fixed assets, current liabilities, non-current liabilities and equity. So let's explore what these really mean and in what circumstances you would post something to one of these categories. So firstly here we've got revenue. Let's be honest, this is pretty self-explanatory. Posted to revenue is all your sales and income. So for example, if you sell flowers, any flower sales, for example bunches of flowers, you'd post to revenue. Direct costs. Now, direct costs are costs that are directly included in generating revenue. So using the example of a flower shop again, your direct cost would be the cost of purchasing the flowers from a supplier. Or if you're a bakery, it could be the cost of buying the butter to make your cakes. Direct, what are the direct costs that are going to help you generate your income or make the goods that you are going to sell? Overhead costs. So these are any other costs that aren't directly linked to generating revenue. So for example, you could have heating bills, computer costs, rent costs, stationery, accountancy costs, telephone costs, basically all of the other costs that a business has that doesn't make them any money. Basically, these are the costs that you want to have as little as possible of. Fixed assets. Fixed assets are called fixed assets because in theory they are difficult to move, i.e. physically move. They are big, bulky items. These are items that you simply cannot consume. So fixed items are actually your stuff, your things, your belongings. Items that you would include in fixed assets are commonly computer equipment, laptops, Macs, that sort of thing. Buildings, now they are pretty difficult to move. Office buildings, that sort of thing. Office furniture, so office desks, office chairs, boardroom furniture. And also any shop fittings, so anything, the design, the sign, the cupboards, that sort of thing. When deciding whether to categorise your transaction as a fixed asset, basically apply a bit of common sense, to be honest. Don't go categorising all your things as fixed assets. So, for example, I wouldn't bother categorising a ruler or a stapler because they're too small. For example, looking at the stapler, I would categorise that as stationery. This is an overhead expense rather than office equipment. Just because of the size and the fact that it's such a small value. To make things more simple, most businesses only categorise assets over a certain value. So, for example, an arbitrary figure of assets over £100. So, for example, if a business bought a printer that cost them £70, whilst that is a fixed item that they can't consume in a year, because it is below £100, they would then post it to computer costs, which would be under the category of overheads. Current assets are items you own or that are owed to you that you expect to be converted to cash within a year. So, for example, you've got stock. You would expect to convert stock to cash via selling your stock. You would have debtors in here, so these are customers that you sold your services or goods to that owe you the money. And then cash itself. So this is everything that's owed to you. Current liabilities are amounts that you have to pay out within the next 12 months for items you've already used in your business. So for example, you've got trade creditors in this category. That's money you owe to suppliers. So for example, you get your electricity bill in, but you haven't yet paid it, but you've used the electricity already. That would be a trade creditor. Loan repayments that are due in the next year, or accruals. Now, these are costs which have been incurred, but you haven't yet received a bill for. So, for example, I would put together a set of accounts for a client. Now, that cost is incurred and relative to the year I'm preparing the accounts for, but I don't send them the bill until after their year end. So this is money they owe me, but they haven't received the bill for yet. Right, non-current liabilities are liabilities in the same sense as the current liabilities, it's just, you've guessed it, they are non-current. This means these are expenses you'll have to pay out, but more than a year away. Now, generally, the most common type of non-current liability is a loan. So, a bank loan. For example, you could have a bank loan that's payable over 5 years. That's £20,000 loan. You could have £16,000 in long-term liabilities and £4,000 in current liabilities. That would mean that in the next year you owe £4,000 in repayments, and the £16,000 isn't repayable until more than a year, so between year 2 and year 5, basically. Equity. This is everything that's owed to the shareholders. So this is share capital, which is contributed by the business owners. So basically, the owners buying their shares, and also any retained profits or losses made by the company in prior years.